Hello and welcome to this session in which we would look at fund accounting. Fund accounting is covered in a governmental accounting course and most importantly the CPA exam. If you are studying for the CPA exam, this topic gives students a lot of problems. FarhatLectures.com, my website, can help you with the CPA exam. I don't replace your Becker, your Roger, Gleim, or Wiley. What I do is I supplement your courses. I can add 10 to 15 points to your CPA exam by helping you understand the course a little bit more in depth, a little bit more in details. Also, what I want you to do is to check out my website where you have access to your university pass rate data for the CPA exam. This will give you an idea how well or how rigorous is your accounting program. Also, on my website, you have additional courses, governmental and not-for-profit on its own, has its own course. If you have not connected with me on LinkedIn, please do so. Like my YouTube lectures, share them, put them in playlist. If they help you, it means they might help other people. And connect with me on Facebook and Instagram. So what is fund accounting and how is it used? So that's the purpose of this session. Also, we're going to look at the elements of financial statements, but we're going to more look at fund accounting. So what is a fund accounting? Well, if you remember the purpose of governmental reporting, what's the main purpose? Is accountability. Is to provide accountability to the users of the financial statements, and the users are usually the voters, the people that live in that county, city, state, whatever. So we need to provide them accountability. So to provide them accountability, we need to make it easy for them to show them what's going on. Okay, and because of that, what's going to happen is we're going to break the government into multiple entities. How so? What's going to happen for each major project or a major revenue or a major event, what we're gonna do, we're gonna create a fund. So what is a fund? A fund is a physical and an accounting entity with a self-balancing sets of accounts. What do you mean by accounting entity with a self-balancing sets of accounts? It means each fund has its own accounts, its own chart of accounts, its own general journal, its own general ledger, its own trial balance, and its own financial statement. So think of a fund as an entity within the government, an entity within an entity. So it has its own sets of books. So each fund, again, it's like its own company. Like in the real world, when you have a business, we only have one business, so we do accounting for one business. In the government, what's going to happen, we're going to break the government into various entities, and each entity we're gonna have something called fund for it, and we're going to account for that entity separately. Again, the reason for this is accountability, and another reason for this is internal control. If you really think about it, the government have no owners. So who are the owners? The voters. So the voters are interested in what's going on. So we want to make it as easy as possible for the voters to focus on one thing that they want to learn about. For example, if the city is building a school, we might have a capital project fund for that school. If the city is raising taxes for a special purpose, we were going to raise taxes from food and beverages, from fast food, to pay for healthcare. Well, that's a special purpose project, special purpose tax. Therefore, we create a special purpose fund, kind of its own entity. So this is the idea that we want to be thinking about in terms of fund. Now, I'm going to be a little bit more specific, and we're going to break the funds, as far as we're concerned, into two groups. We're going to have one group, which is one type of fund, which is a loan. It's called the general fund. This is the general fund. Okay, and we're going to call this fund basically unrestricted, but we'll discuss this in a moment. Okay, and we're going to have many other funds that are restricted. Restricted in one sense. In what sense? Restricted in their use. So we use them for a specific purpose. They're called restricted funds. And we're going to have a lot of them. But the government could only have one general fund, and we're going to see why that's the case. Well, let's name some restricted funds. Well, we could have what's called a special revenue fund. Okay, so what is that fund for? And we could have many of them. We could have one special revenue fund for taxes on fast food. We could have one special revenue fund for the highway, because we want to collect money on the highway, and therefore to repair the highway. Therefore, it's a special revenue fund for the highway. Okay, so this is one type of fund. We could have a special revenue. To service the debt, to service our debt, we could have a debt service fund. And that service fund is its own sole purpose is to service the debt. And we could have many debts. We could have a debt with Bank A, a debt with Bank B. We could have many type of service debt. We could have bonds. We could have all sorts of debt. We could have capital project fund. When we say capital project, is to do what? Is the construction of building, construction of roads, construction of schools. It's a capital project. Now, don't worry about all of this. We're going to cover each fund separately later on, a little bit more in details, but this is the overall picture. So those are the restricted fund. So what about the general fund? We said the government could only have one general fund. So the general fund is basically a catch-all fund. So anything that's not restricted in any way, shape, or form, it goes into the general fund, generally speaking. So it has unrestricted resources. So the general fund will have unrestricted resources to do what? To operate for the general operation, And we're going to talk about this fund later on specifically, again, for the general operation. Now, the idea is this. The idea is each fund, for example, each fund, as we said, it has its own sets of books. So the general fund will have assets, they will have liabilities, they will have their own financial statement. The special revenue fund will have its own assets, liabilities, trial balance, financial statements. Debt service fund, assets, liabilities, financial statement. Same thing for the project fund, for the capital project fund, and the same thing for any other special purpose fund. We are not limited. Those are just three main ones. And we could have many capital project funds, many service project funds. So keep that in mind. So this is the idea of a fund. So it's like a checkbook for each fund. We have a checkbook, keeping track of expenditure. And we're going to define that term eventually. Okay? So we're keeping track for the expenditure. Okay? So that's what a fund is. And we're going to talk much more about fund, but that's the whole idea about fund. The next thing I'm going to look at is the 7 key elements of the financial statement for a government entity. So 5 are relating to the financial position, and the financial position is the balance sheet. Basically, what we know about is the balance sheet, and 2 relating to resource flows. And resource flows, basically, it's going to be something similar to the income statement. So those are basically the elements of financial statement for a government. Just like we learned about those when we took intermediate accounting, they're similar to a great degree. They're similar, but they're different. Similar, but different. Let's start with assets. So how do we define an asset for a business? For a government, very similar to a business. It's a resource with the present service capacity. Present service capacity to what? To service the government. Whatever we need to do, we have that resource available. We can use it. That's an asset. What could be an asset? Cash, supplies, receivables. Very similar to a business. Very similar to a regular business. So you should be familiar with assets. Liabilities. What is a liability? Hopefully we all know what is a liability. It's basically debt. And the official, basically the formal definition, present obligation to sacrifice resources. So the government has some sorts of an obligation to do what? To provide services or to pay down their liabilities to a third party. Basically, that's what a liability is. So nothing really surprising about those two assets. Two elements. Let's take a look at something new. So I'm gonna say this is new, and I'm assuming you never heard of it if you never took governmental accounting. So the third account we're gonna look at is called deferred outflow of resources. Okay, so let's look at the definition first and try to explain what's a deferred outflow. It's the consumption of net asset applicable to a future reporting period. Let me give you an example. Let's assume the government grant money to another entity. So one government, the state government, granted money to the county or to the city. And they told the city, you need to spend this money in the future for XYZ, for a specific project, for the housing of the poor. Okay? Now they send them $1 million. They assign, they actually send it to them. So they send them $1 million. But that $1 million, it's going to be spent in the future. It's not going to be spent in this period. It's going to be spent in the future. So how should we account for that $1 million? Well, guess what? Easy. We're going to reduce cash $1 million because we transferred the cash. But the county or the city is not spending the cash yet. So what's going to happen? We're going to increase an account called deferred outflow of resources, $1 million. If you really think about it, what are we saying here? Hopefully you picked it up. We're talking about prepaids. Basically, we prepaid for a project. We prepaid for a program. The government prepaid for the program. We're not gonna call it prepaid, but we're gonna call it something very similar to prepaid. Deferred outflow of resources. Okay? It's basically, I'm gonna put it in quote, it's an asset, so it gets listed with the assets. But we're going to call it specifically deferred outflow of resources. So that's basically a new term that you need to be familiar with. Another term you need to be familiar with is deferred inflow of resources. Deferred inflow of resources. Well, let's look at the definition. They'll try to explain what's a deferred inflow of resources. Nothing fancy, something that you saw before, but it's a little bit different. What is deferred inflow of resources? The acquisition of net asset applicable to future reporting period. So here's what's going to happen. We are going to be acquiring net asset. We're going to be, we receive the net asset, but that net asset is applicable to what? The future reporting period. In other words, we cannot account for this as the resource in this period as revenue. We're going to have to defer it for future period. Okay. What does it sound like? To a degree, it sounds like unearned revenue in the real world. An example will be the government received taxes from future period that should be spent in future period. So now they receive the taxes. So someone prepaid their taxes, okay? But that's for next year. Well, guess what? The government received the cash, so they're going to debit cash. Okay, in the real world, if you receive money before a service is provided, you create a liability. Well, to really tell you the truth, the government doesn't have a liability. The government, if they receive taxes, they have no liability to service you. Otherwise, we would credit liability. If they're giving you back the money, it would be a liability. But what they have is a deferred inflow of resource. So that resource is not, it's not considered revenue yet. It's kind of a deferred revenue, basically, which is unearned liability. So what we do, let's assume it's $5,000. So we debit cash. And what we do, on the other hand, and this is keep acting up, what we do on the other hand, we credit deferred inflow of resources. Deferred inflow of resources. Okay, so that's the credit. Well, you can think of it, yes, it acts like a liability. Why it acts like a liability? Because we credited the account to increase it. So deferred inflow of resources, we're going to credit the account. We're going to credit this account $5,000. So yes, it does act like a liability, but keep in mind, we cannot call it a liability because, in quote, legally, the government does not have a liability to the taxpayer. All what they did is they received the money before they're supposed to treat it as revenue. Therefore, it's deferred inflow of resources. So those two accounts are new. In a sense, they are new. Okay? Remember, deferred outflow of resources treated like an asset in your mind. Deferred inflow of resources treated like a liability. Treated like a liability. Now, sorry, my screen keep on skipping. I'm not sure why. Okay, now we have something called net position. Net position. The term is new, but the concept is not new to you. Net position is the residual of all element presented in the statement of financial position. So what account did we present in the financial position? Well, we just went over the account that we presented in the financial position. What are those accounts? Assets, liabilities, deferred outflow of resources, deferred inflow of resources. So what we do, if we net those out, whatever is left is called net position. It's the residual value. So it is assets plus deferred outflow, which is similar to assets, minus liabilities, minus deferred inflow, which is similar to liabilities. Let's see it from a different perspective in a formula. So we'll take assets plus the deferred outflow of resources, which is very similar to an asset, minus liabilities and the deferred inflow. So basically, simply put, assets minus liabilities. And what do we call asset minus liabilities for a business? We call it equity. Now, we're not going to call this equity here. We're going to call it net position. So it's the same concept. We're going to call it net position. We may call it we're going to see later, shortly, we might call it the fund balance, and we're going to call it fund balance for certain account, net position for other account. Okay? Or we can call it, it used to be called net asset, then FASB, you know, they don't want you to call it net asset anymore. So in case I call it net asset is the difference between asset and liabilities. And this is GASB number 63 requires that the government, unlike business, must report the third item in a separate category. So that's why we have those, the third item. It's just required because they're not really assets, they're not really liabilities. So that's why, but they act like an asset, they act like a liability. But this is what net position is. And we're going to talk about net position much more tonight in this session. Okay? So that's what net position is. And all these accounts here, the first 5 accounts that you have on the screen in front of you now, assets, liabilities, the third outflow of resources, the third inflow net position, those are called the financial position accounts, or AKA the balance sheet account. Well, 2 other accounts, they act like an income statement account. They're called resources flow. They act like an income statement account. One is called outflow of resources, and if you really read it, outflow of resources, consumption of net asset applicable to the reporting period. So we are consuming asset, and what do we do when we consume asset? We expense it. So we're basically consuming asset. So basically, we're talking about expenses here. So we're talking about expenses. We're talking about expenditure. What is that word expenditure? Just hold your horses. We're going to define expenditure, but for now, think of it as an expense, but it's not really. It's not technically an expense. It's an expenditure, but similar to an expense. Losses, other finances, uses, paying off loan, those are outflow of resources. Okay, we're using our resources. It's outflowing. It's leaving us. Okay, think about expenses. Inflow of resources, acquisition. So basically the opposite. Now you're acquiring net asset applicable to the reporting period. How does the government acquire net asset applicable to the reporting period? They're going to generate revenue. What type of revenue? License fees, taxes, so on and so forth. Gain. They might have a gain. Sell something and have it in a gain. Other financing resources, like they might have borrowed money. Hold on a second. Borrowing money is an inflow of resource? Yes. Yes. If the money is coming in, so it's an inflow of resource. So those are basically what we called, those 2 are technically, or we can think of them as income statement accounts. So those are the 7 elements of the financial statements. Okay? And remember, those 7 elements could appear on any of those fund balances. Okay? Let's take a look at, again at that equation. Assets plus the third outflow, which is assets equal liabilities plus the third inflow plus fund balance. So basically this is saying assets equal to liabilities plus fund balance. Now you're asking, hold on a second, didn't we just use net position? I told you net position and fund balance, they're technically the same, but we're going to define the difference between them in a second. Okay? We could rearrange this formula and we could say assets plus the third outflow minus liabilities minus the third inflow equal to the fund balance. So we could say assets minus liabilities equal to fund balance. So when do we use fund balance? When do we use net position? In the financial statements that are prepared on the full accrual basis, and this is the accounting basis, full accrual accounting basis. And hopefully you remember what full accrual is, and if you don't worry, we're going to cover this in the next session. If you're preparing the financial statement using the full accrual, we call the residual amount net position. So we use the term net position. In a statement that are prepared on a new important term, modified accrual basis, we call this account fund balance. And we're going to focus more on fund balance in this session, but we're going to talk about modified accrual in the next session. Just know if you're using full accrual, and you're going to learn when to use full accrual, when to use modified accrual. So don't worry about this. Just know the rule. Full accrual, we use net position. Modified accrual basis, we use the fund position. Okay? Notice both fund position and net position like owner's equity. In other words, there is the residual, the difference between assets and liabilities, which is assets and the third outflow, liabilities and the third inflow. Do not worry, we're going to cover all these terms much more in details. This is just an overview picture of what is going on. Now we're going to dig a little bit deeper. We're going to dig a little bit deeper into this fund balance. So the best way to look at a fund balance, first I'm going to look at the different funds. So I'm going to look at different funds, then we're going to come back and talk about the fund balances. So let's take a look at different funds. So hopefully you can see this. This is a balance sheet. This is a balance sheet, and it says governmental funds. And remember what I said earlier, we have basically two groups of governmental fund. We have the general, I said, and the government could only have one general fund, and we could have many other, and we call those restricted in a sense that they are used for a specific purpose. Let's take a look at these funds here and just kind of try to get an idea, try to get an overall picture. For example, this fund here, it says it's federal, state, and local government grant. So this fund deals with only state, different type of grant, federal, state, and local. We have this fund here, it's called special taxing areas. So we're raising taxes, like kind of a special revenue. We're raising taxes in a special area, so we'll keep track of this fund separately. This fund, service concession and reserve fund, basically some sort of a revenue. Okay, service concession and revenue and reserve fund. Again, it has its own sets of accounts. This fund, it says bond note redemption and interest. Basically, this is like a debt service fund. This fund, it says community development and improvement project. I would say this is like a capital project fund. And we have other governmental funds. Okay, we'll talk about why do we have other governmental fund later on. So we have different types of fund. But notice all of those, we could have many of those, but only one general fund. And notice here, let's look at their balance sheet. Nothing should be at this point surprising. Assets, we have cash and cash equivalent, investments, cash investment with escrow agent, receivables, due from other funds. Due from other funds is basically a receivable, but the other fund, so basically maybe the general fund sold something on account to another fund. So the funds, they can have transaction amongst each other. And we're going to look at this later on. Due from other government. We have receivable from other government. Inventories. Restricted cash and cash equivalent. Now this is a little bit special, but restricted cash, basically, it's very similar to the sinking bond in the financial accounting. Restricted investments. So we have total assets. Then we have liabilities, voucher, payable, bonds and notes, accrued interest. You should all be familiar with those things. Due to other funds. Due to is basically a form of a liability or a form of accounts payable, AP. Accrued and other liabilities, line of credit. Nothing is unusual. Nothing is unusual. Nothing is unusual here. Nothing is unusual here. Then what we have here at the end, so we have the assets here. So notice we have the assets for the different funds. We have the assets here. We have minus the liabilities here. And asset minus the liabilities, we're going to call it, since this is governmental fund, we're going to call this fund balance. It's fund balance. Now notice the fund balance, what's happening to the fund balance. We have something called non-spendable, restricted, committed, assigned, unassigned. So simply put, what GASB wants us to do, the Government Accounting Standard Board, they want us to take a look at the fund balance and break it down. Tell us these fund balances, what is their nature? Are they non-spendable, restricted, committed, assigned, or unassigned? So now we're going to look at how do we define those terms? How do we define certain fund balances? So those are fund balances kind of qualification. And basically they could be broken down into two groups. They could be broken down into spendable and non-spendable funds. So basically, now we're going to look at GASB number 54. Fund balances of governmental type are now to be reported based on a hierarchy in 5 different classification. One group of classification is non-spendable fund balances, and we're going to have another 4 groups that are what we called spendable, unassigned, restricted, assigned, and committed. Those are spendable. Now we're going to define each one of those. We're going to define each one of those. Okay. I'm not going to go over the slide because it talks about proprietary and fiduciary fund. You did not cover those yet. I'm just going to cover those for now. So cover what I need to cover for now. So fund balances identified between non-spendable and spendable. The non-spendable, usually we have one type, amount that are not in spendable form, such as supplies, inventory, or need to be maintained intact. For example, the government might have an asset like an investment, but the principal is restricted. You can only use the interest for any purpose or for a specific purpose. It doesn't matter. But the principle of that investment, so somebody gave the government $1 million. Okay, they gave the government the $1 million, and they told the government, you cannot use the $1 million. So hold on a second. Why did you give me the $1 million? Well, you can use the interest. So the government can invest this $1 million, but they cannot touch the $1 million, but they can use the interest for anything that they want to. So that $1 million is considered non-spendable. Okay, in that sense, we call this amount non-spendable. Okay. The spendable is the remaining balance and is reported in categories based on constraints. So the spendable, we're going to talk about the spendable balances. So the spendable, those are the spendable. The spendable fund balances can be restricted, committed, assigned, unassigned. So now we're going to go through each one separately and explain when would the fund balance be restricted, when would be committed, when will be assigned and unassigned. Once again, here we are working under the fund balance, which is kind of equity or retained earning, whatever you want to think about it. The first one, the first spendable resource is the fund balance is restricted. Okay. What is restricted? Okay. It's restricted to specific purposes by their providers through either constitutional provisions or enabling legislation. So basically the government, the highest government, basically by legislation, they made this resource restricted to a specific purpose. Okay? Or that resource could be externally imposed, the restriction could be externally imposed by constraints such from the creditor, bondholder, grant providers, contributor, imposed by law through constitution or enabling legislation. So when would the fund be restricted? The fund would be restricted when whoever gave you this fund, they want you to restrict it for a specific purpose. So the restriction could be made by legislation, or it could be made by outside parties who have leverage on the government. For example, if you contribute money to the government or to a nonprofit, we're going to talk about nonprofit later, you have the right to tell them, I want this money to be spent in a specific way. So we call this resource fund balance, restricted balance. Okay, so enabling legislation authorizes the government to assess or mandate payment of resources and include a legally enforceable requirement that the resource be used only for that specific purpose. So you can only use it for that specific purpose. An example will be state allowing cities to collect taxes on food and beverages for street maintenance. So you collect that tax, but you can only use it by law. By legislation, you can only use it for street maintenance or for some specific purpose. So the funds are restricted. Okay, so this is the restricted, and this is the highest constraint. If the funds are restricted, basically no one can really touch it. It's for that purpose. All right. Now another spendable resource under fund balances, the fund balance is committed. Committed by who? Usually it's committed by the highest government authority. So the constraints are imposed by a formal action by the government at the highest level of decision-making authority, like the city council committing funds for construction contract or a rainy day fund. So now the government, the local government though, notice, no one outsider like a creditor or contributor. It's the government, but at the highest level, restricting the use of the funds. So these funds cannot be used for any other purpose unless the government, now remember, the government is imposing, so the government can remove it or changes the specified use by taking the same formal action that was originally imposed by the constraint. So they have to follow the same procedures that they did originally, to make this fund committed, to make it not committed or change its purpose. So who could change a committed fund? The highest level of government. In other words, whoever placed that commitment in the first place. Committed funds include contractual obligation for which existing resources in the fund have been specifically committed for that use. So that's what a committed fund will include. Note, in contrast to fund balance that is restricted by enabling legislation, amount in the committed fund balance, again, can be redeployed as long as we take the appropriate action, the appropriate due process. And usually the appropriate action is go back and reverse exactly what you did originally. So this is what a committed fund balance is. Then under spendable resources, we could have a fund balance that's assigned. Assigned usually will have, it's coming from a lower authority, not the highest authority. So the government intend to use the fund for a specific purpose. So the government decides in a meeting, we're going to use those resources for this purpose. So it's basically its intent. Now, once they intended, they can assign it. So intent can be expressed by the government body itself or another body that has the delegated authority. For example, management could make the suggestion. So notice it's a lower authority. It doesn't have to be the city council. Okay? Fund balance and other governmental funds, okay, other than general funds. So fund balance, other than the general fund, that's not restricted or committed, is considered assigned. So remember, we have, let me go back here. We have government, we have a general fund, the general fund, and we have the other funds. Under the other fund, if something, that's what we're saying, if something not restricted and not committed, if it's not restricted and not committed, it becomes assigned, basically like a default category. Just know this. So in those other funds, I'm gonna highlight them in a different color here. In those other funds, not total, in those other funds, if an item is not restricted and is not committed, so there is no restriction, there is no commitment to it, then by default it becomes assigned. Okay, it becomes assigned for certain things. Okay, in other words, it's the residual balance of these funds. So therefore, that's where you dump the remaining of your fund balances. If it's not restricted and not committed, you dump it in the assigned. Okay. Note, once again, the authority for making an assignment does not have to be made by the government highest level of decision making. I already told you this. Constraint imposed on assigned amount can be more easily removed or modified than those classified as committed, and obviously restricted, you cannot even touch it. Okay? So it's, again, it's easier than committed, easier to change than committed. And the last fund balance that we're going to talk about is the unassigned. And this is really cool because it's unassigned. Guess what? It's not restricted. It's not anything. It's the residual classification of the general fund. So in the general fund, that's the whatever we have left, it's going to be unassigned. So if it's not committed, it's not restricted in general fund, it's not anything, then it's unassigned. What does that mean? Include amount that are available for any purpose. This is what unassigned is. So the government can do anything with it. Note this. Only the general fund, GF, can report this positive unassigned fund balance. So only the general fund, which is that only one fund, could report a positive, unbiased fund, positive unassigned fund balance. Okay. For governmental fund, this category is used to report only negative balances. So for other funds, okay, the unassigned balance will have a negative. Why? Because when expenditure exceeds revenues, we're going to have to plug in a figure. So it's going to go negatively into the fund balance. And the best way to look at this is to see actually a picture, what we just talked about. So let me clear this. Sorry, I cannot make this bigger, this balance sheet any bigger, but we're focusing down here. But once I do this, I cannot really write on my screen. But we're focusing right under, let me see if I can do this. So we're focusing on the fund balance. Notice it's non-spendable, restricted, committed, assigned, and unassigned. So I'm going to go back down. Now I can write again. So under the general fund, anything that's not non-spendable, non-restricted, not committed, not assigned, it automatically goes into unassigned. And the unassigned will be positive. And the unassigned, it's the only unassigned fund that can be positive between all funds. Okay? Notice if we go to, let's look at the special taxing area fund. Notice the special taxing area fund, all the funds are restricted. Let's take a look at the service concession and reserve. So if we look at this fund, we have 620,891 of this fund balance committed. Okay, committed by someone in the government. Now, the fund balance does not balance. So assets minus liabilities. So if we take assets minus liabilities is not equal to 620. What's going to happen? We're going to plug the difference into the unassigned as a negative. Notice here it's a negative. It's negative 1,576,293. So basically it's a plug figure. Okay. Let's take a look at the debt service fund, bond note, and redemption interest. So we have, let's see, assets. We have total liabilities. We have the third inflow. Oops, sorry, this is the third inflow. And notice what's going to happen. This figure here is a plug, negative 26,000. Why? Let's use these figures, might be easier to follow. Okay, so if we look at assets for the debt service fund, for the debt service fund, let me get the calculator again. My assets at 1,025,164. Assets minus liabilities and deferred inflow minus 631,985. 631,985 minus 420,051. Notice it does not balance. Asset minus liabilities, equity should be basically negative 26,872. Where do we plug in this negative? We plug it under for the unassigned. So notice it's basically a plug in that sense. And we did the same thing here. If we take assets minus liabilities and deferred inflow, and what's going to happen, we're going to have a committed fund balance of 620, and whatever is left to make assets equal liabilities plus fund balance, it's going to be a negative figure. This is what we meant by that statement. So notice we're gonna need to know about this later on. So just basically get the overall picture. So this is basically a crosswalk. The X is likely. The question mark is we could possibly have it. No is prohibited. For example, special revenue fund. Notice all the fund except the general fund. Okay, all the general fund cannot have a positive unassigned fund. And we already told you this, but this is a picture, and the picture sometimes worth 1,000 words. So notice all these funds, special revenue, debt service, capital project, no positive unassigned. They could have negative, okay, because remember I told you it could be it's used a plug to make sure assets equal liabilities plus fund balance. Okay. Now the special revenue fund, the special revenue fund, it could have a non-spendable. It could have non-spendable, possible. Definitely it would have restricted because it's a special revenue fund. It's a special for something. There's a good chance it would have a some commitment to their fund balance, and it could have also assigned. Debt service fund, it could have a non-spendable. Usually they don't, but they could. Or definitely it's restricted because it's for the debt service. Definitely it could have committed, and definitely it would have assigned. Okay, capital project fund, they could have non-spendable, but definitely they will have restricted fund balance, definitely they will have committed, and definitely they will have assigned, because the capital project fund is to do what? You are building something for the government, so you want to have a fund for that project specifically. We did not really talk about the permanent fund. We'll talk about the permanent fund later. Matter of fact, we're going to cover all these funds shortly in this chapter, but this is just an overview to explain restricted, committed, assigned, negative unassigned, and positive unassigned. Notice the general fund. The general fund will definitely have non-spendable item, and it will definitely have a positive unassigned balance. The only fund that will have positive unassigned balance, which is unrestricted, and it could possibly have any of those because it's the general fund. It could have anything. Okay. And how many general funds do we have? One. How many of these funds do we have? We could have many special revenues, many debt funds, many capital project fund, so on and so forth. So this is what we learned. This is an overall picture. Just bear with me. Everything that we mentioned, many things in this session that we're going to have to define later, such as those different funds we're going to talk about later. I throw the word modified accrual. What is that? I throw the word expenditure. We used it. Don't worry. Just the next session, we're going to talk about modified accrual. And with the modified accruals, we're going to explain expenditure. We're going to look at the measurement focus. Which fund do we use economic resource measurement focus? Which fund do we use current resource measurement focus? And hopefully you observed something. And if not, I'm going to point it out to you now. Notice, I want you to notice two things. Maybe you noticed it, maybe not, but I'm going to talk about it in the next session. Notice under asset, I did not have no long-term asset. Did you notice this? I hope you did. And under liabilities, no long-term liabilities. This is important. Fund balances, they will not have long-term assets. They will not have long-term liabilities. Why? That's the topic of the next session. Again, at the end of this recording, I'm going to invite you to visit my website, farhatlectures.com, where I have supplemental material to your existing CPA course. I cannot replace those courses. I wish I can. Your CPA exam is a lifetime investment. Invest wisely in your career. You are investing for 30 to 40 years. Don't shortchange yourself. Good luck, study hard, and most importantly, stay safe.